CMQ investors, welcome to the show. This is Chris Franco, and I've received a number of DMs about what's going on with Netflix today. So we'll talk about that, and I'll also share some enduring lessons from Warren Buffett and Charlie Munger that this news can help us, I think, better remember, retain, apply, use, take advantage of, profit from, exploit. First, let's get into the news. This comes from the Wall Street Journal. It says that Netflix shares were on course for their worst day in over a decade after the streaming giant reported that it lost subscribers in the first quarter. The shares shed more than a third of their value after markets opened Wednesday. Investors expected that the company would add new users in the quarter, but instead, Netflix said it ended the first 3 months of the year with 200,000 fewer subscribers than it had in the fourth quarter. Instead, it expected, and this is big, it expected to lose 2 million global subscribers in the current quarter. Okay, so what's going on? Well, the stock is down more than 60% this year, and that includes today's fall. But the bottom line here is Netflix had expected to add new subscribers when in fact they lost subscribers. The expectations were not met. Wall Street reacted very unfavorably, and that's where we are now. Now, I'm not saying that, I could have seen this coming because, well, I don't own Netflix shares, but I also didn't short them. But to be fair, I don't short stocks, period. But Netflix is experiencing something that Warren Buffett has talked about over the years, and that is Netflix is experiencing the corrosive forces of competition. So competition is something that most businesses, even great businesses, have to face. But there are some that have what Warren Buffett would call a durable competitive advantage or a moat, and a moat that's actually getting wider over time. In the case of Netflix, at least in the United States, there's been an onslaught of new entrants into the streaming space. So Disney Plus, Paramount, Apple Plus or Apple TV, Amazon Prime, HBO Max, Hulu, CMQ. You get the idea. The point is, beyond that, their business is getting more and more expensive because it costs a lot of money to produce new content. And because so many companies are aggressively trying to add original content, all the costs across the, call it, video production universe have gone up. So this is not an easy business to be in. Not that it ever was, but it's increasingly difficult even for a first mover and a brand leader like Netflix. And I think that's in part what we're seeing. Now, I wouldn't count Netflix out. I'm not making any predictions about the future, but this it seems like an overreaction by the market. It's pretty devastating. And especially devastating to people who loaded up on Netflix when shares dropped. I think it was 20% earlier this year based on some other news. Now, what is Netflix going to do about that? According to the earnings call transcript that I was just skimming through before I started recording this video, Netflix is considering doing some sort of ad-supported model, cracking down on people who are using duplicate accounts and things like that. But, at the end of the day, this is a big change for Netflix. Now, if we go back to another company that comes to mind here, which is Apple went through something similar in 2016. It was the first quarter that I recall anyway, where they had a down quarter on revenue. I'm not trying to say it's an apples to apples comparison, but it'd be stupid to count Netflix out. However, there is only so many smartphone makers that can really exist and dominate in the economy or in the world. That's clearly not the case with these streaming services. So let's try to relate this back to some enduring wisdom from Warren Buffett and Charlie Munger. Now, my favorite Berkshire Hathaway letter, or at least right now, is from 1996. And in that letter, Warren Buffett says the following: "In studying the investments we have made in both subsidiary companies and common stocks, you will see that we favor businesses and industries unlikely to experience major change. The reason for that is simple. Making either type of purchase, we are searching for operations that we believe are virtually certain to possess enormous competitive strength 10 or 20 years from now. A fast-changing industry environment may offer the chance for huge wins, but it precludes the certainty we seek." So Netflix, there might have been certainty there, but now with so much competition, with them raising prices, trying to flex and see if they have pricing power, and just having to do things that they didn't have to do prior to all this new competition, well, the future earnings are a lot less predictable, and as an investor or a long-term investor, there's a lot less certainty. Now I want to conclude with another quote here, this one from the vice chairman of Berkshire Hathaway, Charlie Munger. Charlie Munger notes, "Frequently, you see a business having fabulous results. And the question is, how long can this continue? There's only one way I know to answer that. Think about why the results are occurring now, and then figure out what could cause those results to stop." Thank you for listening to the CMQ Investing Podcast. And if you haven't already, make sure you subscribe on Apple Podcasts or Spotify. It's totally free, and that way you'll receive every new episode as soon as it's released. Thanks again, everyone. We'll talk soon.